Let's talk a little bit about the credit spreads. Why this is the one strategy that I think whether you're a beginner or an experienced trader, you should learn to master if you're looking to grow your trading account. So a credit spread is an income generating strategy. It's generally suitable for when you have a mild directional view on a stock or ETF. What that means is that simply if you can basically look at a chart and generally see that it's drifting in one direction or another, that's all you generally need in order to potentially trade that underlying security. You don't necessarily need to know where you think the stock's going to go. You don't necessarily need to have a fundamental view or necessarily even a strong technical analysis understanding in order to trade these types of strategies. If you can look at a chart and generally see that a stock is drifting in one direction or another, that's enough as a starting point to potentially trade it. It's also a forgiving strategy. It has naturally a higher probability of profit, so you're going to win more than 50% of your trades right off the bat. And it has limited risk and limited reward, so you know exactly how much you can potentially win or lose on a given trade before you get into that trade. So you can calculate the right number of contracts so that no matter what happens, you know what your best case and worst case scenario outcomes for each one of those strategies are. And that's why credit spreads, in my opinion, belong in every portfolio for options traders. So let's look at an example here. As I said, the only thing you need is a basic view of a chart. As you can see, if I'm looking at a chart here, the stock is generally trending higher. That's a potential opportunity to take a bullish credit spread. So let's lay this out. I'm looking at Alibaba. It recently broke out above that $80 level. It's trending higher, starting to trend higher here. This could potentially be the candidate for a bullish credit spread. So I'm going to walk you through the construction of this credit spread right now, and then we're going to come back to understanding why I chose these specific expiration dates, strike prices, and the construction of the trade. So at the time, this Alibaba is trading at about 82.5 or so. What I'm doing in this particular case is I'm going to sell an at-the-money put option, an $82 put option, and I'm going to go out to the June 28th expiration, which is roughly 45 days from expiry. I'm sorry, it was at the time 36 days from expiry. So I'm going out slightly higher than slightly higher than 40 days from expiration. And what I'm doing is I'm selling an at the money put. So in this particular case, by selling that at the money put, I'm collecting $3.14. Now, for those of you, if you're familiar with selling a put or a naked put, what you're doing is you're effectively betting that the stock is not going to move lower, that as long as it stays where it is or moves higher, you'll be able to collect the $3.14 credit on this short put. However, when you sell a short put, there's two things that I think is challenging, especially for those of you that are new to options trading or if you have a small account, because selling a put requires a huge amount of margin to trade and you're taking on a substantial amount of risk, the same risk as buying the stock outright. So that's a risk that perhaps you're not willing to take, and perhaps you don't have the margin requirements to hold on to selling a cash secured put. You need about in this particular case, nearly $8,000 in cash to sell one contract, not something that everyone has, which is why we're turning to a credit spread.